Does the stock market always go down when inflation rates go up? Has the stock market ever gone up with high inflation? Hi, I'm Garrett Ray, financial planner here at the Wealth Guardians and the Ray Financial Group.
And I'm Brice Payne, and you've entered The Vault, the Wealth Guardians video series on all things pertaining to retirement planning. In this episode, we're going to talk about what impact does inflation have, what does inflation influence other than prices, when is inflation most painful, what is a real return, and is there ever a good level of inflation? You're going to notice those like and subscribe buttons down below the screen there. Feel free to click on those if you want to catch future episodes of The Vault with Garrett, Doug, and myself. All right, Garrett, let's go ahead and get started on this. Talk to us about inflation.
Yep.
What impact does inflation have on us, Garrett?
Absolutely. So let's just talk about the general impact that we see across the economy. Of course, the first to feel the pinch, so we speak, of inflation is going to be the consumer. At that point, the necessities of life become more expensive. We're talking groceries to put on the table, gasoline in the car. In some cases, even your utility bills will be rising. So they're the first to hear it or to feel it. But we also have to take into consideration the overall economy. Well, over time, corporations start to feel the pinch as well. Let's keep in mind that if prices are rising, the cost of simply doing business, buying the raw materials that businesses need to process to turn out their products, are also becoming more and more expensive. So what happens? Essentially, as costs go up for companies, their profit margins get compressed or they get squeezed. And now suddenly, corporations don't look like such a good investment anymore.
Okay.
If you're an investor and you're sitting there on the sidelines and you're watching a company quarter over quarter have their profits go down and down, even if you wanted to invest in the economy and into that company, you're a little bit more hesitant to do so because you're saying, hey, their profits aren't steady. And so that's how inflation can have the double whammy. Not only is the consumer hurt, but corporations, in a lagging effect, are also hurt.
Okay. Talk now about what does inflation influence other than prices?
Yeah, so on a broader scale here, inflation, of course, influences prices, but they also are highly correlated to interest rates. And so there's interest rate uncertainty. Right here now in 2023, we're seeing that particularly in the real estate market. So now, we just had 3 years ago, where you could get a 30-year fixed rate mortgage at less than 3%. Nowadays, as we're filming this in October of 2023, that is unheard of. And you're getting 30-year fixed rate mortgages, even for those with excellent credit, approaching 8%. Last I checked, it was like 7.95.
And we had topped over 8% at one point.
Yes, so it's peaked and come down slightly. But you can see how those who were lucky enough to find themselves and buy a home 2 and 3 years ago at less than 3%, there's no way that they're getting out of that mortgage now. They'd be silly to do so.
Right.
So you start to have interest rates influence all kinds of industries, and right now we're seeing it in real estate.
Right. Okay. Good point. When is inflation most painful to us? I mean, it's always painful to some degree, but when is it most painful to us?
Yep. And just like anything related to the markets, inflation plays a key here in that uncertainty the market is completely scared of. So inflation is most painful when you have extreme changes. If you go from a low inflation rate and then over the course of, say, 12 months, 18 months, then you're into a period of really high inflation. We're just experienced that, by the way, in 2022.
Yeah.
So you're starting to feel that pinch, and the uncertainty of the speed of that cost increase is what really spooks the market.
Okay.
We have had periods in our history where inflation has been relatively high. We're talking 5, 6, even 7%, but it's been steady. It's been a steady rate year over year over year, and the consumer starts to adjust to that. The corporations start to adjust to that. So it's really the wild swings of going from low inflationary periods to super high inflationary periods in a compressed amount of time that really start to squeeze both the consumer and the markets.
Yeah, we're going to throw up a graph here in just a minute to show you what Garrett is talking about. Garrett, explain to the viewers what real return is.
Yeah, so real rate of return. If you may be looking at your statements at the end of the quarter or say the end of the year, and you get those net returns on your statements and you say, oh, great, I was up 10%. Well, you were up 10% on the investment side, but your purchasing power as a result of inflation also needs to be considered.
Yep.
If you made 10% in a given year, but inflation in that same year rose 5%, your real rate of return is actually only 5%, not that 10%, because your purchasing power with that money, should you sell that investment to capture your profit, so to speak, is now worth 5% less in real purchasing power.
Makes perfect sense.
So the real rate of return is something that we have to factor. This is another reason why high inflationary periods can also spook the markets.
Very good. All right. So last question I'm going to ask you here is, to some degree or another, we always have inflation, and we tend to think inflation is bad. But is there ever a good level of inflation that we want to have?
Yep. There is a good level of inflation with slow and steady inflation, and we're typically the sweet spot is right around 2 to 3%. And if you follow what the Fed kind of talks about in their quarterly meetings, they'll talk about targeting this 2 to 3% rate of inflation. An inflation rate like that is healthy because purchasing power is, yes, it's slowly diminishing, but that also allows expansion within corporations so that they can hire more. And typically, they also have pricing power. So they can start to slowly increase their prices, slowly increase their profits, but it's not so much of a sticker shock to folks that people quit purchasing. So that's the healthy level of inflation that the Fed, and really, if you look at real rate of return, which we just touched on, highest real rates of return are experienced when the markets have had about a 2 to 3% inflation rate. So that's a good level of inflation. Okay.
All right. Perfect. Let's go ahead and throw up on the screen here this graph that you put together, Garrett. Tell us what we're looking at here.
Yep. So below in the YouTube link, we'll have the links to all the data where this was compiled from. But what we have here is, this is a chart I put together, Brice. What I was curious about was, how does the stock market, or specifically the S&P 500, perform during different inflationary periods? And so let's talk about the bar charts first. We went all the way back to 1926, all the way through to present day of 2023. And the green bars that you see are positive years for the S&P 500, and the percentage of return is there on the left.
Okay.
The red bars are obviously negative. Those were down years for the market.
All right.
And then the area of peaks of blue is how extreme was inflation, or in some cases in the 1930s, deflation.
Okay.
And the question that we tried to ask was, how much of an influence does inflation have on overall stock market returns? And there's a couple decades we can look at here where we can see some pretty significant and interesting things. Obviously, the 1930s following the stock market crash of 1929 were actually deflationary.
Okay.
And at that point, the entire economy was having to essentially reset. Yes, you were essentially able to purchase more for your money, but money was very hard to come by during that type of depression. So we can see how the rate of, in that case, swift deflationary, as the blue kind of area shows, really upset the markets. And also, there was very little money circulating in the economy at that time, so it was hard for your average day folk.
Okay.
Then you fast forward into the wartime years, the 1940s. Well, World War II was kicking off, and the entire war machine started to turn from an agricultural economy to a more industrial economy at large for the United States. Inflation was relatively high, but there was obviously a very major cause that everyone was putting that energy towards. And you actually saw coming out, actually towards the latter end of the war and coming out of the war into the 1950s, yes, we had high inflation, but the overall economy was juiced by that industrial push that we put into the war. Now, if we go further, you can see that we've had some shocks in the economy. The late 1970s, this is when essentially we had to really combat inflation. People might remember Paul Volcker and the Fed as he increased in interest rates. And we saw that had a negative effect coming out of the late 70s into the 80s. Now, what's really interesting, though, is if we continue on into the mid-80s, you can see if we follow the blue area graph there, that's about a 5 to 6% inflation rate year over year over year. And really what I'm looking at is from 1984 all the way through to the late 90s. We actually had a steady 5 to 6-ish% inflation rate. And yet, most people who lived through the 80s and the 90s will tell you that was one of the best bull markets we've ever had. So what does this tell us? This tells us that the market can be resilient to what we might perceive as high inflation. Remember that 5 to 6% is higher than our target sweet spot of 2 to 3%. It's the rate of change that spooks the market.
Right.
So let's take a look at something else here. We can also see that the market doesn't necessarily go down just because of inflation. You can have non-correlated events. So I'm looking at the early 2000s, or the so-called dot-com bust.
Right.
Well, we can see that we had about a 2 to 3, 4% inflation rate there. But that downfall in the market was not due to a rapid change of inflation. That was really due to an industry collapse that got way overbought, and yet inflation remained relatively flat during that time.
Just a popping of a bubble there.
That's right. Then we go to 2008, the financial crisis of 2008, where essentially we had to drop from a relatively healthy 2 to 3 to 4% inflation rate down to zero. And you can see how negatively, with everything going on in the financial markets, 2008 was. And then what's interesting is if we jump forward to present day here in 2022, 2023, everyone knows the news headlines. You can see how quickly inflation has popped for us going out of 2021 into present day. And obviously 2022 was a tough year for folks. Market S&P 500 down around 17, 18% there. So I think the main takeaway here is that, does the stock market always go down due to high inflation? No, it doesn't. What's most important is really how quickly does that inflation pop up and smack us in the face? Because not only does the consumer have to adjust to it, but corporations have to reset their entire business model for what they're purchasing and what they're selling in order to keep the economy churning.
Garrett, would it be fair to say that sometimes the market is dictating what inflation does, and sometimes inflation is dictating what the market does?
That's a stickier question. I would say that there are times when what central banking moves do can actually shape the markets.
Okay.
So if the Fed is going to have a policy which is pretty hawkish, and they're purposely trying to increase interest rates and inflation rates, typically to cool the economy down.
Right.
If the Fed perceives that things are heating up too quickly, we're about to enter a bubble, that's the reason why they would do so. So you can have some central banking moves, and I would say that that's honestly the main reason for what happened back in 2022. The Fed knowingly was increasing interest rates that time. But you can also have market conditions that pop up, such as like a massive supply loss, where now we have resources that are suddenly more and more rare. So in order to get them, prices go up. You have fewer and fewer buyers, or the buyers who need those materials are more strapped in order to get them. Okay. That was, I think, of like the gasoline lines back in the late 1970s that people experienced. So that can be a market condition that causes inflation. So,
okay.
Yep.
Perfect. So sometimes one leads the other.
Yep.
Anything else we wanted to cover? I mean, this was a great crash course in inflation, and we really covered all the bases here. Anything else you want to add in here before we go?
No, I think that was good. Just wanted to give the viewers out there just kind of, understanding that inflation and stock market returns are not one-to-one.
Right.
We really have to dig through the data to understand what was happening at that period of time in the markets. And also, too, there have been periods of time that our country has gone through of high inflationary periods. Again, let's go back to the 1980s, that 5 to 6%, relatively high inflation, when the stock market actually performed incredibly well. So it's more how quickly, or the rate of change of inflation, rather than the overall year-over-year percentage.
Makes perfect sense. Well, thanks, Garrett, for that crash course there. That's going to wrap it up for this episode of The Vault. Again, feel free to hit these like and subscribe buttons down below if you want to catch future episodes of The Vault. And remember, financial plans do not create themselves. I'm Brice Payne.
And I'm Garrett Ray.
And this has been The Vault.